Well, good morning. I'm Jagendra Rana, and the topic of the day is surrender value rules in India. Surrender value rules in India. After several revisions, the Insurance Regulatory and Development Authority of India has finally released new regulations on the surrender value of life insurance policies. So initially the draft shared in December 2023 proposed high surrender values for policyholders. However, the final master circular issued has little bit moderated these values, though they are still higher than the existing rates. So for those unfamiliar, surrendering a policy means fully withdrawing or terminating the policy before the term ends. So the surrender value paid upon surrender is the higher of the guaranteed surrender value, that is called GSV, guaranteed surrender value, or the special surrender value, that is called SSB. So currently policyholders can surrender their policies at any time during the term, provided that 2 full years premiums have been paid. So surrendering before this period incurs heavy cost with no refund. So the new IRDA master circular states that SSV calculated shall become payable after completion of the first policy year, provided 1 full year premium has been received. This is good news for policyholders, as under existing rules, no surrender value was paid in the first year. So according to the new rules, insurers must ensure that the SSV is at least equal to the expected present value of the paid up sum insured or sum assured on all contingencies, paid up future benefits, and accrued or vested benefits, accounting for any survival benefits already paid. The interest rate used for these calculations cannot exceed the prevailing yield on 10-year G-Secs plus a 50 basis points spread. So for example, if someone has a 10-year policy with a sum assured of rupees 1 lakh, an annual premium of rupees 10,000 and a policy bonus of rupees 50,000, so the present value of the paid up sum assured plus the future bonus according to the new regulations would be rupees 7,823 or 78%. So the paid up value of an insurance policy depends on the proportion of the premiums payment made. It is calculated using the following formula. And the formula is paid up value is equal to number of years for which premium has been paid upon total policy term into total sum assured. I repeat the formula. Paid up value is equal to number of years for which premium has been paid upon total policy terms into total sum assured. So these new regulations are expected to increase the overall surrender value for customers and have to be implemented by September 30, 2024. So currently after 2 years, policyholders are only entitled to the guaranteed surrender value. For instance, surrendering after the second or third year typically results in a refund of only 30 to 35% of the total premium, excluding bonuses. So this proportion increases with the policy term, reaching 50% if surrendered between the 4th and 7th year and 90% of the last 2 years. So while we anticipate a gross impact of approximately 100 BPS on the company's new business margin, that is called NBM, new business margin, due to higher surrender value on early exits, we are confident in our ability to largely mitigate this impact without compromising the value proposition for our customers. So we expect these measures to positively impact the long-term growth prospects for the industry. Now, after the initial draft shared in December 2023, the IRDA in April 2024 announced planned to back down on surrender value proposals in December 23. So beyond this threshold, no surrender charges would be levied on the remaining premium. You mean by May 2024 they introduced a framework to implement the increase and invited insurers to submit feedback and seek potential relaxation on the proposed SSP increase by May 31st. And in the draft regulations of December 23, IRDA had proposed the concept of a premium threshold for each product. Beyond this threshold, no surrender value would be levied on the remaining premium irrespective of when the policy is surrendered. So to illustrate, consider an endowment policy with an annual premium of ₹1 lakh and a policy term of 20 years. So assuming a threshold limit of ₹25,000, the guaranteed surrender value after the payment of the third annual premium could be computed like this. The guaranteed surrender value for the threshold premium would be ₹25 into 3 into 35%, equating to ₹26,250. 26,250. So the premium refund surpassing the threshold premium would be ₹1 lakh minus ₹25,000 into 3 or 2,25,000. So therefore, the adjusted guaranteed surrender value would sum 1 plus 2 up to ₹2,51,250. The surrender value would be the higher of the adjusted guaranteed surrender value or the special surrender value. So it would have been a significant jump in surrender value because as per the existing regulations, one would qualify for 35% of the premium paid, equivalent to ₹1,05,000. The Master Circular issued on life insurance products also announced about a simplified customer information sheets, training programs, mandatory policy loans to enhance liquidity, introduction of variable entries, extended free look period, robust processes to address customer grievances, and higher value to customers on early exit should further the regulator's vision of insurance for all by 2047. So if a policyholder wants to exit his life insurance policy during the initial years, he'll get a higher refund from the insurance company now. So after several rounds of discussions and proposals, the IRDAI has ordered a higher special surrender value for traditional endowment policies. Now the policyholder will get a part of his premium back even if he exits after 1 year. So this will indeed offer more liquidity and flexibility to life insurance customers if they want to switch their policies. So what is the special surrender value rule proposed by the IRDA? How will it be calculated? How much will the policyholder get back if they prematurely exit their life insurance policies? Will the rule apply for existing endowments? Now these questions are answered. Because now this Master Circular for Life Insurance Business dated June 12, 2024, IRD has illustrated all these things. And in addition, private life insurers have performed well in the April-June quarter, but new surrender value regulations will trigger changes in the way the industry functions. So given higher payouts, insurers are likely to focus on persistency and they must cope with the likely adverse impact on VNB margins. VNB is value of new business. So apart from focusing on customers acquisition with high persistency levels, they will have to review the higher upfront commission structure to encourage persistency by increasing tail commission. So they will also have to review non-par products, that is IRRS, means internal rate of returns, and consider new offers like loan on insurance to address customers' cash flow needs. So the insurers expect a gross impact of 100 bps on VNB margin due to higher surrender value on early exits. Insurers have already experimented with trail level commission structures in products and are looking to modify commission structures. The non-linked business is about 20%, which will mute impact. Max Life expects impact to be in the range of 100 to 200 bps and is working towards mitigating this impact with the restructure of distribution, commercials, and realigned maturing and surrender propositions. And SBI's life management does not expect much impact on margin given its ULIP driven product mix. No change, no commission structure is expected. So there is some post quarter 1 FY25 guidance on growth and margins as follows. HDFC Life targets doubling VNB in 4 years and hopes to outpace industry in retail APE, that is annual premium equivalent growth. ICICI Pru Life Management hopes to outperform industry growth in FY25 while maintaining VNB growth in line with business growth according to earlier guidance. Max Life has guided for VNB growth in the mid-teens. SBI Life is targeting AP growth in the high teens to 20% with 28% VNB margins. So this is the way how insurance companies are dealing with. Now insurers are focused on ULIP as a category to drive growth. Since capital markets have done well and high ticket traditional products are being hit by changes in taxation, so new products and funds in the ULIP space will capitalize on strong stock market trends. So there has been a positive impact on sum assured driven by growth in retail protection and higher attachments of riders and saving products. How the strong performance and the fact that these changes will ultimately make insurance more attractive to customers should drive growth. In the medium term, stocks of HDFC Life and SBI Life hit 52 weeks high on last week, while ICICI Prudential Life stock did so this week. According to Bloomberg, most analysis called in August are positive on these 4 stocks. So this is how the surrender value is playing the key role in the industry today, because the move is in favor of the policyholders. Those who stuck with the wrong product due to rampant mis-selling that has become quite prevalent in the insurance sector will get a higher amount back now. The provision for higher surrender value calculated at a prevailing 10-year government securities rate with a limited spread significantly increases the value returned to policyholders in the event of a policy surrender after the completion of the first year. So IRDAI faced a lot of backlash from consumer advocates for giving in to the demand of insurance companies on guaranteed surrender value a few months back. But with the new master circular, IRDAI has tried to compensate consumers by trying a special surrender value calculation to a discount factor based on GSEC. It's a welcome step and would help end customer in receiving higher surrender value. So the regulator also said that the insurers can offer higher guaranteed surrender value than those specified in the regulations. These values may vary with premium size, premium paying term, policy term, the duration elapsed at the time of surrender, and other relevant factors as applicable. Thank you very much.